Hi, everybody. This is Dr. Gregory, and this is ACC4620, Auditing and Assurance 2. We're going to look at Part 3 of Chapter 7 in our video lecture today, Identifying and Assessing the Risk of Material Misstatement. Now, risk is all around us, personal as well as in our business lives. In business, risk is that concept that we predict as part of the life cycle of the business, that there will be experiences and issues that may create a threat to its business operations. And we have internal and external client risks to think about. Some internal risks include whether or not management is effective in how they conduct business or what their mission, vision, and goals are for the business. Do we have toxic cultures at the business? Do we have a lack of tone at the top? Do we have threats of company disruption, perhaps some hostile takeovers or employee issues? We might even have technology changes that companies are not prepared for. When we have technology changes, it usually will cost the company some amount of money or resources in order to upgrade their systems. And some companies just may not have that flexibility to implement new change. Some external risks are, macroeconomic forces such as inflation, the recent pandemics, foreign and global issues. We have issues regarding interest rates, regulatory changes, product location. So we have these not dueling or competitive, but sometimes interrelated threats going on that could add risk to a business. Many times I've seen people confuse business risk to financial risk, and business risk hits the vulnerability and viability of the continuation of a company, whereas financial risk is more the risk that the company places in on its debt. Are they getting too debt heavy or too equity heavy? And what that can do, it could lead to a business risk, but until it leads to the business risk, it's just a financial risk. If you look at Exhibit 7.1 of your text, there's a number of questions you want to ask yourself as the auditor when assessing business risk as it relates to financial statements. When we are looking at developing client risk assessment or business risk assessment, there are a number of different procedures that auditors have to take in order to make sure that they have fully vetted and addressed potential risks. One is talk to management, inquire to management what's been going on in your company over the last year, what issues have risen to the table, what challenges do you see? You might want to do a SWOT analysis based on those management inquiries. You also want to take a look at the budget and see where the company is positioning its resources. Are they looking at accumulating more assets, maybe developing enough reserves to expand their company? So you want to see where the resources are being put to use, and do those resources meet management's inquiries? Do the resources that they're budgeting match their mission, vision, and goals? You definitely want to tour the client's company and multiple locations if they have multiple locations. You want to see what the business looks like. You may want to be taking a quick view of assets or inventories that the company has. You want to observe its observations. Then you want to step back and understand what government regulations impact that company and that industry. So this is where you need to do your due diligence and make sure you have a good understanding of the company and the industry. Look at the government regulations surrounding it. You want to understand their systems, such as what is their procurement system? What is their accounting or information systems? What kind of technology do they have in place? Perhaps if they are a production company, what kind of production equipment are they using? Are they using outdated equipment? Are they using newer equipment? That could have an effect on whether or not there might be risk or vulnerability to that organization. You want to perform some online searches. They're very easy to do. If they're a publicly traded company, look at their SEC filings, their 8K and their 10K. Their 8K is their quarterly reports. You want to probably take a look at what's been going on in the last 2 or 3 quarters, or what announcements they've been making regarding shareholder purchases and sales. You want to look at the company websites for a couple of reasons. One, you want to know what they're putting out about their company and see if that aligns back to the information you got from the management inquiries. You always want to go back and see if there's alignment going on, or if there is a disconnect going on from what management thinks they're doing versus what the website or any of these other areas could be producing for them. You want to take a look at investor websites. We mentioned this before in lecture number 2 for chapter 7. Look at the investor websites. What is CNBC saying? What is Yahoo Finance saying? What is Reuters or Bloomberg saying about these companies? Are they showing any kind of concerns? You probably also want to look and do a little investigation on whether or not there has been reviews of their products and services, whether or not there have been complaints. Type in the company and put in reviews, complaints, lawsuits, litigations to see if there's something going on that they may not be divulging to you. You then want to look at the economic information, and this is where we go back to the industry. What's going on in the economy of the industry? Is the industry overall showing maybe flatline or downturn, and all of a sudden the company you're looking at is just booming? That's a disconnect. That's an area that we want to look at and say, why are you not aligning to what's going on normally in the industry? You want to look at whether or not there have been tax regulations underneath the government regulations. You also want to look at the economic indicators as to, are they growing? Are they stagnant? Are there companies that might be threatening them as far as taking over or being substitute products and services for them? And finally, you want to look at the AICPA and what bulletins or risk assessments they may be having regarding that industry. The AICPA, I believe almost every year or every other year, puts out risk alerts. And that's based on what they have seen as benchmarks throughout audits produced by other companies. And they want to come out and they do state what's going on in the industry. What should we as auditors be on the lookout for? So we really have to put our feelers out there and get a really good understanding of what's going on. And it starts with inquiring of management, because you want to get their point of view. And then what you're doing with the rest of these processes is either confirming or disputing what they say. There are 4 parts to an audit risk model, and we're going to look at first inherent risks and control risks with some examples. There are these 4 major risks that we look at that can impact a company and its operations, and how those risks can then be reflected through the financial results of the company. So the first one, the inherent risk, is just a natural risk that occurs in the process of the company that might lead to a material misstatement. And it might be an individual issue or an aggregate issue. So we would be looking at the transaction entries, the account balances, and disclosures regarding those areas where naturally something disconcerting could happen. One, for most companies, cash is an inherent risk, and it's an inherent risk of being stolen. So it's a high risk right there. We know that cash could be stolen. We could also look at the type of transactions. If a transaction is extremely complicated or complex, such as what Enron was doing, or if the company was performing an inordinate amount of estimates in their reconciliation entries, that might lead us to a natural risk of misstatement, because people may not have the sophisticated training to perform those. So they may inherently create misstatements. Some other examples might be high volume, non-routine entries. Perhaps at odd times of the year. Say you've got a company that focuses on seasonal cycles for sales. Big sales at Christmas time, maybe big sales at Easter time. But then all of a sudden you're seeing in off periods high volumes of sales. You might want to investigate that, because that might be a natural area where misstatement could occur. You also want to look at the miscellaneous accounts, miscellaneous revenue, miscellaneous expenses, and take a look at the volume of transactions and the amount of those transactions. Those are natural areas where material misstatement may be occurring. Now, control risk is a risk that just can't be prevented or detected or corrected individually or in the aggregate. And it's an entry that could occur again in a transaction, an account balance, or within the disclosure. So some examples of control risks are an error in the disclosure notes because the employee didn't understand the disclosure notes. So you have an employee writing the notes for the company, and they merely copy and paste the information from last year to this year. Well, error could be occurring that we might not prevent or detect, because that employee may not be aware of what they are supposed to be doing in creating those disclosures. Another example could be poor controls in locations. If we are not out in that location, we may not be able to detect or prevent poor controls occurring, which could lead to financial misstatement. Another example is, can you get access to the organization? If you either scheduled or unscheduled, you want to go to the company site and say, I'm going to come and look at inventory, and the company puts you off, or the company delays, that might be an issue that you're not going to find something that could be prevented or detected because you don't have access to that location. And anytime you get pushback on location access or inventory access or asset access or confirmation access, that should you should be seeing, hearing sirens going off in your head and all kinds of alarms going off. The other two risks are more on the auditor's side that we have to be cognizant of. One of them is providing the wrong opinion, giving an unqualified opinion when in fact there were instances of errors done by the auditor that may have resulted in an unqualified opinion, or a qualified opinion, I'm sorry. So you want to be sure that you are aware that you as the auditor may make audit risk errors. You might also make detection risk errors, and that's performing the wrong tests. It could be setting materiality wrong so that it allows irregularities to flow through into the financial statement. So 2 of the risks are company risks. 2 of the risks are your risks. So you need to be able to document in your working papers that you are aware of these risks and that you are doing your due diligence as an auditor to reduce or mitigate the risk of that misstatement. The basic formula for audit risk is the inherent risk times the control risk times the detection risk. And while that seems like it can be a numerical formula, it's more, again, of the auditor's professional judgment, where we're looking at that company and that industry. So if you've got a company that you are looking to audit, or you are in the beginning stages of planning an audit, and this is a company in which the industry has been highly regulated, carefully monitored, PCAOB has been providing information on it, it may result in a low audit risk because of the monitoring that that company and that industry has had to be a part of. On the opposite side, you might be looking at preparing a planning engagement for a privately held company where you have very little information. There are no publicly released financial statements. There might be very little information on the internet about it. You're not getting much from management. You may have to find that they are higher risk because of that lack of information that can lead you to creating a good risk assessment on them. So you may be performing your risk assessment within the throes of the audit, which can often create a need to reassess your risk. Exhibit 7.2 in your text has a really good diagram of risks relevant to the audit. So I want to go through this really quickly for you. When we're looking at the client business risks, the auditor sets the audit risk. And remember what the audit risk is. That's what we control. That's our risk that we're going to give the wrong opinion. Then we have to look at the inherent risks and the control risks within the company and the industry. Those are the risks that are controlled by the client. That has to do with how transactions are reported and recorded, how disclosures are performed. Those are the risks that we have to assess whether the company is performing those to an adequate standard. And then again, we determine the detection risk. Based on our audit risk and our inherent and control risks, what is the chance that we're going to miss something in the audit that could lead to an error in the audit risk of opinion? Now let's switch over a little bit. As part of our audit, as we're looking at these material misstatements and these control and inherent risks, we also have to keep in the back of our mind fraud risk. Remember, we learned about what the difference between an error and an irregularity is. An error is just a mistake, but those mistakes may add up to the point where it creates a materiality issue and can form an opinion to us as to whether or not the financial statements are presented fairly in accordance to standards. So as your team is getting together, one of the steps that we looked at back in materiality is having the team, after they've done inquiries, come back together and start talking amongst themselves. What do you see? What did you hear? What do you note? What kind of issues kind of percolated to the top of your mind as far as potential fraud risk? That's part of this brainstorming. And actually, brainstorming is part of auditing standard 2110.52 of the PCAOB. It actually addresses the need for teams, for the audit team to get together and brainstorm. And one of the things I consider brainstorming to be is speak up, not shut up. Everyone in the team should be expressing ideas, thoughts, information, next steps based on what they have perceived. You need senior staff in there to help guide the brainstorming, but you need junior staff to come in with those ideas and thoughts and concepts that they may be seeing that you may overlook. So the aim is to transfer this knowledge and ideas amongst each other, because everyone's going to see the company through different lenses. And we need those perceptions, because while senior staff are experienced, they may become complacent. And it's just natural. I know this company. I've been doing audits for this company for the last 3 years. I know what's going on. But you need those junior staff, those newer staff, to look at that with a fresh pair of eyes and maybe bring some things to the forefront that you might not have considered. So some suggested steps in this is, take a look at prior year information if you have it. Now, you can ask the company for permission to reach out to a prior audit firm and see their working papers. It's up to the company whether or not they want to give you that access. If you have that prior year information, take a good look at it and note to be aware of changes to the company that could change the results of the financial information. Between the prior year and the current year, did they make a change in accounting principles or estimates? Was there change in key management staff? Was there a change in the company profile itself? Did it grow? Did it shrink? Did they sell off operating segments? Did they expand? You need to be aware of what's going on to make sense of the prior year and current year changes. Think of the company in the perspective of the fraud triangle. During that brainstorming session, what did the team observe? Hey, I noticed that when I was observing the payroll, that the accounts receivable clerk hasn't taken a vacation in 2 years. That might be an area of interest. Does somebody perhaps have the pressure, motivation, and opportunity to conduct fraud? Did we have new employees come in? We might want to look at training records. Has the company now decided that they want a 7% increase in sales from last year to this year? Is that even attainable? So you want to take a look at things from the idea of the fraud triangle. And could there be pressures and motivations out there that could create an opportunity for fraud? If you do find something like that, assess the likelihood. There's a person in a key cash position that makes $40,000 a year, but is driving a $65,000 car. Doesn't mean that they didn't have their, that it wasn't a legitimate purchase, but it's something to look at. Assess the risk. I think that if we would have looked at the Rita Crudwell case from that light, if the auditors would have looked at it from that light and have seen the controller of Dixon, Illinois, going off fairly regularly on horse exhibitions and horse showings, it might have raised some red flags. How could a person that made $80,000 a year have these horses and this nice a home and that nice a car and that nice a motorhome? But those questions weren't asked. So you always need to be looking at that. And finally, if you assess it and you see that there may be a potential for irregularities to be occurring, how will you approach your risk as the result? What type of substantive tests will you perform to either confirm those suspicions or refute them? Now, part of those substantive tests can come from analytical procedures. And we really do rely now on analytical procedures to kind of give us a gauge of changes or ratios that may lead us to wanting to dive deeper. So first, determine the appropriate analytical procedure and know that one size does not fit all. Just doing a horizontal trend analysis over the past 3 years isn't enough to set the tone of your tests. You need to do a variety of procedures. You need to do horizontal trend analysis, vertical trend analysis, do some ratio analysis, maybe do some Benford's Law or some AI analysis or big data analysis if the company is large enough to start looking for anomalies. So it could depend on the type of account you're looking at, the classification of the account, to determine which is the best analytical procedure. Evaluate before you start that analytical procedure the reliability of the data and the account balances. Your ratio results are no good if your data isn't good. So look at the data, the underlying data, for example, in sales, and look for those perhaps anomalies in the sales before you start relying on sales to do your ratio analysis. Then develop an expectation of what that balance, what that ratio should be. Look at industry benchmarks. You can go out and look at industry ratios. You can just Google it on the internet, and it will give you the industry. Pull up an industry, the airline industry, and it will give you what the benchmark industry numbers are. That could be very close to your expectations. If you have a downturn in the economy in the airline industry, you should expect poor ratio analysis in some of your profitability ratios, and even perhaps in your liquidity issue ratios. So go in with the expectation of what those balances should be, and then look at the client records. What are their ratio analysis? Sometimes they will publish ratio analysis within the MD&A in the audit report, sometimes in the disclosures, but usually in management's discussion and analysis, there may be some supplemental schedules on ratio analysis where they may be benchmarking themselves against the industry as well. Take a look at what their expectations are. And how close are your expectations to the clients? Then compare their records to your expectations. Is there anything that stands out? If you understand the industry and you think the industry is going has been on a decline because during the pandemic, people weren't flying, but yet you're seeing unusual revenue, strong ratio analysis during that time. Do your expectations match up to the data that the client is producing? That might be standing out to look in deeper. Investigate those that don't meet your expectations. And then document, document, document. Document your story of this. And then what is the conclusion? Here's a quick review of analytical procedures. We can use trend analysis, horizontal and vertical. You want to do both. You want to look at the balance sheet and the income statement. Don't just rely on the balance sheet. That may not tell you much of anything, really. Compare prior years of the company. Compare it to their competitors. Take Delta and compare it to United Airlines. What's going on with both of those? Are they in line with each other? Compare it to the industry. And be cognizant of changes between the years, especially in horizontal analysis, that could skew these results. Ratio analysis. Look at all of them, the liquidity, the profitability, the solvency. Your textbook has a lot of them in there. You can always Google financial ratios. You can go into corporatefinanceinstitute.com and search ratios. It will give you the definition of the ratio, the formula of the ratio, an example of the ratio, and what you should be looking for as far as the results. What do the results indicate? Again, ensure that the underlying data is reasonable. So review those account balances, or your ratios mean nothing. You've identified a risk. Now what do you do? Well, what's the level of the risk? If you've got an inherent risk, the ones where some accounts could naturally be subject to misstatement, you would have a high inherent risk or a low inherent risk. You look at the material misstatement of these risks. Are they high, medium, or low? In the part 2 video for chapter 2, I provide examples of different types of materiality levels. Now remember, it's just an idea and a concept. It will be different for different companies, different industries, and different accounts. But once you've looked at these, determine your audit risk. If the audit risk has a high level, that means that the auditor feels that there is a low level of material misstatement. Therefore, the auditor will gather less evidence. If it's a low level of risk, that means the auditor will gather more evidence because they're not sure if the risk is there or not. We've now identified materiality. We've done some assessment of risk, and now we want to start developing, as an output of that risk, our auditing procedures. We want to do tests of controls as well as substantive testing on account transactions and account classifications. So here's a suggested process for you. First, evaluate why you've determined that level of risk. Document, document, document. Make sure that somebody else reading your working papers can confirm that you're on the right track. What are the inherent risks, those natural risks that could result in material misstatement? Then we want to look at our internal controls of that company and what the control risk is to determine what types of tests to perform. Do we have sound policies and procedures? And are the employees following them? Then we may not have so many tests that we have to perform. However, if it's chaotic, if there are no solid processes and procedures, if we see unsecured assets, if we view that management may have stated in an inquiry that they review and will make corrective entries to the accounts at the end of the period if they feel they're not correct, then you're going to determine what types of tests you're going to have to perform. Weak internal controls, more tests. Strong internal controls, low to moderate testing. And then if your risk assessment changes because of what you are seeing in the evidence, if you feel that 5% of the transactions are, or 1% of the transactions are acceptable to have errors within them, and you find that 5% actually have errors, you're going to want to assess your risk, reassess your risk, and then document that reassessment. When did you find out you needed a reassessment? Why? And what is the new risk assessment? Which will change the amount of evidence you will have to gather. And finally, we want to look at the nature, timing, and the extent of the risk responses. The nature. What type of audit procedures are you going to use? And how are each of those audit procedures going to confirm or refute your materiality level and your risk assessment level for a particular account classification, for a disclosure, and for the financial statements as a whole? Timing. When does the auditor perform or conduct procedures? Now, we saw in a prior video that we have before the fiscal year cutoff, right around the fiscal year cutoff, and then after the fiscal year cutoff. So you want to make sure that you're timing which tests and control procedures you are doing during each of those times. And then finally, the extent of the responses to risk. Sufficiency and quantity of evidence. Are you pulling enough to confirm or refute your assessment? Sometimes we have sufficiency bias, where we are looking to confirm our suspicions instead of letting the audit evidence lead us to that confirmation or refuting. So sometimes we only look at what we want to look at to confirm or refute our position. That's taking the shortcut, and it might lead you down to that audit and detection risks that we talked about. You want to do enough so that you have mitigated the risk that you have provided the wrong opinion and mitigated the risks that you missed something. But you don't want so much. Remember, we're not doing a 100% audit. So in summary, we've identified the client business risks. We looked at risk assessment procedures for identifying those risks. We looked at the audit risk model as far as inherent in control, those that the client controls, and audit and detection risk, those that the auditor controls. We assessed fraud risk as we are going through these steps. We looked at analytical procedures, and we developed some audit procedures. Remember to look at the entire chapter. This is an overview, and there's a lot of valuable information in Chapter 7 to look at. And finally, I want to leave you with this little joke. The CEO and the CFO say, it's risky and we're managing it. And the auditors are sitting back and saying, well, it is concise. It lacks something of a report. If you have any questions, please reach out to me, and I will see you in the classroom.